Hello and welcome to this week's episode for Conservative ETF Investor. This is the stock market update for February 22nd, 2025. I'm your host. My name is Ken, and our model portfolio for the SPY model portfolio, currently we have a yellow for the stock market strength color signal. In 2024, we did have a return using the strategy of 37.29%. This is all the content that we're going to go over in today's video. As of today, the Fed is, according to the Fed Watch tool, the Fed has a 95.5% probability that they're going to keep the rates, the federal discount interest rates, where they are at on the next meeting, which is March 19th. Okay, so what happened last week? For the S&P 500, lost 1.6%. NASDAQ 100 lost 2.24%. And look at the small caps. IWM slammed 3.62% for the week. Terrible week for the small caps. So on Friday, this is the news that came out to make a headline, according to Yahoo News. Stocks sell off as consumers start to sour on the U.S. economy. You know, you have all this news about Trump and Elon Musk and how they're doing massive job cuts and U.S. government cuts because spending has gotten so out of control for so long. So now, supposedly on Friday, the market event, they've been doing this for a little while, but on Friday, for some reason, the market got spooked and pulled back. Sometimes they just put news out there because everyone likes to have a reason. Why did something do something? Maybe the market just wasn't ready to make that jump to the next highest level and do a breakout, because it was right at a resistance point. I was thinking it was going to break out. I was looking for that breakout. We did not get the breakout. We got the breakdown. But it's only one day. One day does not make a trend. So we now need to see what the action is for next week. So I do have 4 portfolios that I manage and send out the alerts to my subscribers. But I only share with you guys one portfolio, and that is the SPY portfolio for the S&P 500. And we sent out no trades last week for that portfolio. All right, now we are looking at a 10-day candlestick chart for SPY with daily candlesticks. This is Friday's action right here. The market, up until Friday, was doing just fine. It did have a little bit of a breakdown here on Thursday, but you'll notice how we came down and kissed the 13-day exponential moving average right there. We kissed it, bounced off of it, came back up, formed a hammer candle. I thought that it was going to be off to the races from there, but no, the market said nope. Then the very next day came down and took a nice solid bath of 1.71% on Friday. All right, here are all the trades that we've made in our SPY model portfolio for 2025. The yellow represents 2 open positions. SPY is currently trading at 599.94, and we currently are negative by a few $100s in each of those 2 transactions when we purchased. Now, our portfolio, we always do year to date. So our portfolio year to date is up 1.04%. And we also have that right there. But what we try to do here, the whole goal of Conservative ETF Investor is to beat the returns of the buy and hold investor. Now, currently, the buy and hold investor for SPY is up 2.36%. So we're behind them by just a little over 1%, which is minuscule over the grand scheme of things. Now that the market is pulling back, we're going to be watching this pullback, and we're going to decide how we want to play that out, depending upon what the market does. I'm expecting support to come in. We are going to do a deep dive into the charts right now. Stick with us, and let's get into those charts in just a moment. One thing I want to point out to you guys, in our portfolio allocation, 91% or just about $120,000 is in shares of SPY. We do have $11,000 or 9% of our model portfolio, because the total of the model portfolio is $131,000. $11,000 of that capital is in cash, sitting on the sidelines that we can deploy as we see fit. We will deploy that capital if needed, depending upon the market action that we see coming up next week and following. Because if this market starts going upside down and I don't want to take a loss on the shares, maybe I'll just buy some puts as protection. Maybe what I'll do is, if the market does reach a bottom and it starts to come up, maybe I'll tack on a couple of calls. I need to see how the market plays out to really determine how I want to play, going either to the upside or to the downside. But the point is we have some capital. We have cash sitting on the sidelines that we can deploy. The buy and hold investor does not have that opportunity. They are all in at their set amount. They're going to start the year off that way and finish the year with that capital, and it's going to do whatever the market dictates. We, as traders, have the ability to make changes throughout the year as things change with the markets. All right, now here is an equity curve of the two portfolios. The blue is the conservative ETF SPY portfolio, and the pink is the buy and hold investor. Our whole goal is for our blue portfolio to be above the pink. Obviously, currently we are not above the pink, and you can see right now on the percentage basis where we currently stand. We have a lot of white space between now and the end of the year, so we have a lot of time in order to beat that portfolio. In 2024, our strategy produced 37.29%. The buy and hold investor walked away at the end of the year with a gain of 23.3. So we smoked them by 14 percentage points. So it's a good strategy. It's not a get-rich-quick strategy. And basically, we're playing it off of trends. So we need to have, the market has to have some type of a trend in order for us to take advantage of that. But we have a whole year to do this work with. We just have to stay on top of it, stay on top of the markets. And that's why I give you guys every single week a weekly market update to show you, okay, we're looking at the market and this is what we see and this is what we plan on doing. Okay, now this is a 5-year weekly candlestick chart for SPY. And here is where we are at right now, and pretty much you can see things are still high and tight. That, on this chart here, you really don't see, you see that red candle, especially here in the thumbnail. You can see that last week's action as the red candle, but when you compare it to the past history, nothing is glaring out at you right now. We still have this negative divergence that still really hasn't cleared. I really want to break that high with significance before I take out that negative divergence on the MACD. The MACD is currently below its signal line heading south. Slow stochastics right at 80 but heading south. So I do see more weakness coming into the market next week. But you'll notice over here I've got the bull symbol. Well, why is that? Because generally speaking, this market is still bullish. I have two exponential moving averages, the 10-week moving average and the 40-week moving average, pretty much representing the 50-day and the 200-day. Over here in the thumbnail, you see that blue line. That is the 10-week exponential moving average. We are still trading above the 10-week. And we're nowhere near the 40-week or 200-day. So until you start breaking down from these levels, you're still in a bull market. So overall bullish. We are in a pullback phases of an overall bull trend. We just need to see how far down does the market want to take us. Now we are looking at daily candlesticks with a duration of 6 months with some cycle brackets down here at the bottom. I've got some different moving averages here. where I've got on the exponential, the 8, the 13, and the 21, and on simple moving averages, the 50 and the 200. The black is the 200, the 50 is the green. You can see that we are just above the green, but we have broken down below the 8, 13, and the 21-day exponential moving average. And it all happened on Friday. So, you know, we had broken out of this range right here. You had this resistance line. We broke out above it. We were trading above it, staying above it. It looked like we're going to come back, do a retest of this line, and then off to the races. But instead of doing a retest, it actually kind of dropped below, did not break the 50. Maybe this is just a one-day anomaly, or maybe this is the beginning of something more disastrous. We don't know yet. We need more candles to be pre-produced in order to determine how the market wants to take this information. We do know that we are heading south here and here on the MACD and on the slow stow. But overall, I've got us down here as a bullish indication. We need to break down further to have further signs that this market has reached its peak, and the peak was right there just a few days ago. Otherwise, we're close to the highs, and this is just a pullback in a bull market. Now we are looking at the VIX Volatility Fear Index, and where do we stand? We are in the low range. The low range is bullish. The number is 18.21. Anything below 20 is a bullish number. We are spiking up. Now, in last week's video, I did mention to you guys, hey, notice how we come down here to the ultra low range and then we shoot up. Bam, we shoot up. Bam, we shoot up. Bam. This time it didn't really shoot up. It just went up a little bit, came back down, but now we're shooting up again. Nothing more than we have done several times in the very recent past. And we're not even in crazy territory. We're not above 20. We're not in a crazy number. So Friday's action so far is not enough information for us to be concerned. We're still bullish this market. Now we are looking at the New York Advanced Decline Line, NYSE, which stands for the New York Stock Exchange, with the Bollinger Bands in green. Last week's video, I did mention, hey, notice how we're at the very top of the range. Now, the market can stay at the top of the range for an extended period of time, but this time it decided to come down, and really it was all because of Friday's action. One other thing I want you to bring out to you guys. Notice how the Bollinger Bands are really coming in tight. Like, you notice between here and here how fat the Bollinger Bands are, but then over here they came in really tight, and then eventually it worked its way out to the upside. So we need to see if this tightness here is going to work its way out to the upside as well. Or remember, the market is an 800-pound gorilla. It's going to do whatever it wants to do whenever it wants to do it. Maybe this is going to be the beginning of something else, and it is going to drop and not go up. So we'll see how the market plays itself out from here, but we're going to be watching everything. I got down here the symbol of the bears and the bulls because we're at the lower end of the Bollinger Band. Normally, when you're at the lower end of the Bollinger Bands on the NYSE AD line, you're going to bounce and come up. You're going to bounce and come up. And in blue, we have the S&P 500 SPY. When that happens, the SPY will also bounce. So if the AD line bounces up, the SPY will bounce up. We're going to get that 2% right back. So, and I'm not even going to trade it. I'm not going to put a call on right now because the market could continue to fall. Just, you know, there's not enough information for me to make an actual trade to go one way or the other. If it continues to fall, I want that cash ready to be deployed towards some action. So right now we're just going to hold and see what the next few days of trading reveal. Now we're looking at a one-year chart of TNX, 10-year US Treasury yields. That's the candlestick chart. I also have in blue SPY, the S&P 500. Black is the ETF TLT, which is 20-year bonds. Now I've been pointing out for a few weeks that we are in a trading range between here and here. We are still in that trading range. We are at the rock bottom of that trading range. Are we going to bounce and come up? Now, even if we do bounce and come up, the market seems to be okay with this trading range. It can still advance, although it won't like it as much as if it comes down. If indeed we do break and come down, that will make fixed investments less attractive because the yield will be going down. So in order for an investor to get that return, they're going to have to go into the stock market or something more risky. So it'll make US equities more attractive. Now look over here at the MACD. You are trading below the signal line and traveling south. Slow stochastics below its signal line, traveling south. There might be enough energy right now in an effort to get this TNX to break this line and to drop down. And the market should respond favorably. The stock market should respond favorably if that were to happen. And we'll see what the next few days of trading reveal. Got down here a bull and also the bear and bull symbol, because if we stay in this trading range, then it's going to be kind of neutral for the stock market action. If we drop down, that will be more bullish for US equities. All right, there is the man himself, Mr. Warren Buffett, the Oracle of Omaha. Over here, CNN Business Fear and Greed Index. We are in fear. Well, generally speaking, I want to buy going long when the market is in fear, and more favorably in extreme fear. We're not in extreme fear, we're just in fear. So I've got down here a neutral symbol for the bears and the bulls. The market can still fall further or start to advance. All right, now we are looking at things from a seasonality standpoint. And we are using 5 years of data. We're currently in the month of February. This is 2025, folks. There's a 40% probability you're going to close higher than when you opened. Well, last week, the stock market was up. So I told you guys from a seasonality basis, we were bearish because according to this data, 5 years of data, we're going to drop between last week's video and the end of the month. Well, currently for the month of February, the S&P 500 SPY is down 0.31%. So now we know that we are down for the month of February. So technically, we have accomplished the goal of being 40% probability of closing higher. Now, as I pointed out last week, I'm going to point it out again this week. These are monthly candlesticks for SPY. This is support. This line is resistance. Look where we are at. We are right at support right now. So we could get a bounce. We could drift a little bit lower and then next month get the bounce. Oh, next month. Next month, the month of March, look at this. A 100% probability that it is going to be a positive month. And so we're currently long. We are long our portfolio in SPY. We think that the market is going to hold right now, and then eventually, starting maybe next month or sooner or somewhere in that area, then we're going to get that bounce that we're looking for and maybe take us to all-time new highs. All right, now we are on the Thinkorswim platform. This is SPY, and it is a 3-year weekly candlestick chart with standard deviations, +2, -2, +1, -1, 50% regression is the dashed green. We are in a trading range, folks. We're between this line right here, the upper end, which I'll bring over to here, and also this lower line right here. We're trading in between. Until we break out one way or the other, we are stuck in that trading range. I'm going to switch over and I'm going to take us to 1 year daily. Change the cycle brackets to 1 year daily. And now, what does this information have to tell us? Here, you can see that we had a support line taken from that low there and that low there. And that drew in that line, and we just breached that line on Friday. And I thought that we were going to break it to the upside. That's what I personally thought, especially because we had our major and minor cycle brackets right there, and it was bringing upward energy, and I thought that we were going to have enough energy to come up and potentially tag this 631. Nope, that didn't happen. The market said no thank you, or at least not yet. And on Friday, it decided to go the other way. I've got an alert down here that's going to be sent to me if we hit 590.68, which takes us to a recent low. We are still doing pretty good as long as we don't take out that low. And even if we take out that low, it's still not the end of the world. But if we start to take out this low, that would be concerning. That would be somewhere in the neighborhood of 575. But we're going to be alerted way before 575 if that were to happen. And hopefully, we're going to find some support between where we are currently at, 599.94 and 590.68. Hopefully, we will find some support in between those two levels and then take off to the upside. Okay, now we are looking at an Excel spreadsheet that I created. This data is fresh as of February 22nd, 2025. So this is taking into account last week's action on the market. Now, the best number you can get using this here for the formula is a 5 or a 6. Anything with a 5 or a 6 gets a color green. The more green on the screen, the stronger you are. Another thing we want to take into consideration is last week's action compared to the current week. Now, the top here, the top section, is asset classes: equities, real estate, precious metals, bonds, emerging markets. The lower section here, those are the 11 S&P 500 sectors. So we take it down and we see what we are doing. We compare last week's reading to the current week. We are losing energy in both asset classes from 61 to 57. We went from a green to a yellow. And also here in the 11 sectors, we went from 62 now down to 45, which is also in the yellow. But what is yellow? Yellow is still a bull market. Really, the red is the worst, telling you that you're in bear market or really not good stock market activity. So yellow doesn't mean the end of the world. Normal market activity pulls you into the yellow range. We're in the yellow range right now. Let's see what happens. Maybe we're going to stay here for a little while and then jump up to the green, or maybe we'll stay here and jump into the red. I don't know. We'll play it as the information comes to us, but this is what the data is telling us right now. I do have in here the bear and bull symbol, representing that this market could go in either direction with this data. Okay, that is going to take us to the conclusion of this video. As of February 22nd, 2025, the market summation, according to me, Ken, Senior Market Analyst for Conservative ETF Investor. So Friday was a good pullback, but one day does not make a trend. SPY is still on course of making higher highs and higher lows. I have a little snippet down here of the 6-month daily candlestick. You have a low, then you have a high. Here you have a higher low, and then here you have a higher high. Take that, come over to here, and it is a higher high. It's just the last 2 days that took us back down. So until we take out this low here, which we have not done yet, but more importantly, this low here, which is somewhere around, what, 592, something like that, or 590. We'll just call it 590. As long as we stay above that, we're still going to be classified as a bull market. And we're going to play it to the long side till we start breaking down from these levels, which we have not done yet. So maybe Friday was just enough to scare some investors who were a little scared about what they're seeing in the economy from what the President Donald Trump is doing. Who knows what they're scared of? But the market does this on purpose. It wants to shake people out. It wants people to move and not be stagnant in their positions. So it tries to get people, it moves the market to the low side and to the top side in both directions to try to get people to trade, to do things. So we'll see how that is going to make the public react. And even though I say what I think is going to happen, the market is an 800-pound gorilla, as I've noted. It's going to do whatever it wants to do whenever it wants to do it. We do have a yellow for the current stock market strength color signal. If you want to learn more about me, I want you to head over to my website. There will be a link for it in the description down below. Also, if you'd like to sign up for real-time trade alerts. I hope you got some valuable information out of this video. If you have not done so already, I want you to smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.